When not one, but two super investors with a long history of crushing the market start buying into a fallen stock, it gets my interest. In this case, we're talking about Tom Gayner from Markel and Seth Klarman from Baupost buying into Dollar General stock, which is down around 50% year to date. Seth Klarman, he was the founder of the Baupost Group, one of the largest hedge funds in the world, a billionaire with a track record of something like 20% over several decades, clearly outperforming the market. Tom Gayner, the CEO and former chief investment officer for Markel Group, also generating a very attractive return that has significantly outperformed the S&P 500 over a multi-decade perspective. And they both were buying Dollar General stock in the second quarter of this year, and Dollar General continued to make lows, down around 50% this past year. So what is it that folks are looking at? Where does Dollar General go from here? Because there's a lot of nasty headlines. What are they seeing, and where can Dollar General potentially go in the future? If you enjoy educational investment videos, you're watching Unrivaled Investing. My name is Daniel. Let's dive right in to understand what is going on with Dollar General. Please make point of hitting that thumbs up, hit that subscribe button. So as we look at the headlines, they are ugly. Talking about shares tanking after blaming poor earnings on theft, weak consumer demand. So that is clearly part of the picture. But the more important picture, and this is super important to understand, is that when management has to lower guidance, that's what Wall Street really doesn't like. It is better if you start seeing the train go off the tracks. It's better for you just to say, hey, you know what? I'm not going to give you death by 1,000 paper cuts. We're just going to scrap guidance all for this year. We don't know how things are going to shake out. But if you do a lowered guidance and then 3 months later you lower it again like Dollar General did, it makes everyone sit and look at you and think, hey, you don't know what you're doing. Should you even be running this business? So they're in the penalty box for that. And you look at their guidance, it is just not great. You're looking at sales growth. They previously lowered it to 3.5% to 5%. Now they're saying closer to 1% to 3%. Then they said same store sales previously, 1% to 2%. Now it might be 0%. Then they're talking about earnings, previously saying an 8% decline. Now it's a 34 to 22% decline. So this type of revised outlook, continued paper cuts, investors do not like to see. Are you actually running this business? Do you know what you're doing? It's better just to scrap it altogether if you're not sure, and if you feel like things are starting to come off the rails. What are the trends that management is calling out? They talked about how things were actually pretty solid in May. Then they got worse in June and July. And then they really started getting worse in August with negative comp sales. And they said, look, overall, we're not satisfied with what's going on, but we're encouraged by some of the overall market share gains. That's a very weird comment to make. Market share is something I definitely look at with my own personal investments because I want to see a company that's taking market share, taking a slice of the pie. Usually you win market share because you have a strong value proposition or even an unrivaled value proposition, hence the name of this channel, as I'm looking for companies that have something special that give them the right to win. And so it's weird for them to say, hey, we're having trouble here. We're looking at, declines and, declining same store sales in August, but we actually took market share. So what's going on? They talk about, the customer is focusing more on buying what they need versus discretionary purchases. So a tougher economic environment with a sensitive consumer. So what they're talking about here with potentially taking market share is how their consumables business was up around 6% during the quarter. This is year to date, up around 7% plus. Whereas you look at individual other segments, more discretionary purchases like seasonal items, home products, apparel, these all actually declined year over year. And so when you see this, maybe they're winning share in consumables. So the things people need, the toilet paper, the ketchup, the food that you need. Yeah, you're going to go to Dollar General. You're going to one of the largest discounters in the United States with around 20,000 stores. They're starting to expand in Mexico, but it's very early days. Looking at this, consumables is driving their growth, but this is lower margin than some of their other products that are more discretionary, like the home products, apparel, and seasonal. And inventory has built up a little bit there. And so now they're saying, oh, we're going to have to do some inventory adjustments, i.e. do markdowns to get rid of some of this stuff. So, I'm looking at this, I'm thinking, hey, if you need to do some home product shopping, now is the time to go to Dollar General, it seems like, because they're going to be offloading some inventory, probably some apparel too, if you're in the market for it. So you're probably going to see some heavy discounts there. Looking at their financials, I personally use AI Ticker Chat, where the first month is free. Yes, their sales grew, and it's mixed by consumables, lower margins, consumables growing versus the discretionary purchases declining. But that gross profits declined year over year. You can see that it went from $3 billion and 44 million versus $3 billion and 48 million year over year. So despite the growth, their gross profit is actually declining, and that actually leads to much lower operating profits because they continue to have to invest in the business. And so you can click on any of these line items to get the explanation if you're interested using AI Ticker Chat. So why, what are some of the challenges? Why are costs going up when their gross profit is flat or declining? Well, they talk about, the typical headline you're seeing right now, which is that right now, unfortunately, in the United States, shrink is just out of control, and shrink means, people stealing stuff. So I think I'm almost of the mindset that we should start introducing like capital punishment in the stores just for people to like figure out, do not rob. Like, what is going on with society that we're tolerating this? It is just absolutely madness. And in the most recent quarter, they talked about how we now expect approximately 100 million of additional shrink just in the last quarter. So they're talking about hundreds of millions of dollars in terms of people walking out with items in the store where they can't account for their inventory anymore. That's impacting their business. And so that is a clear aspect. Society, this is a societal question of, hey, do we treat this seriously? Do we expect people to act like savages, or are they expected to act like citizens? Another key aspect is that they're investing in their business, saying, look, with inflation, people are choosing their jobs, unemployment's low. We need to invest in labor. We need to invest in store hours. So that's another, $150 million investing in this business to make sure the consumer's happy. Shelves are stocked. People can get reasonable service. So the question is, where does Dollar General go from here? It's certainly gotten a shellacking, down around 50% so far this past year. First of all, in full disclosure, this is not financial advice. And also a quick plug at Unrivaled Investing. My goal is to help everyday investors by identifying companies with compelling long-term business prospects, attractive valuations, and aligned management teams. I'm looking for companies that I can partner with and hold for years with the prospect of hundreds of % upside. I share my investment journey in a weekly letter at unrivaledinvesting.com if you'd like to learn more. And so looking at Dollar General, well, I also always want to see what is going on with your competitors. And Dollar Tree isn't a perfect competitor because they're more focused around the dollar mark, whereas Dollar General, yes, it's a discounter, but it does have things that are $10 or more. So it's not exactly perfect, but seeing the growth that they have in same-store sales of between 7 to 8%, Family Dollar and Dollar Tree, it does make me wonder if Dollar General is indeed taking market share, because these are some very strong same-store sales figures that they're posting. Now, they are not immune from this environment because despite their growth, Dollar Tree, DLTR is the ticker, their operating profit is getting crushed as well. Went from 500 million to under 300 million in the most recent quarter. Earnings per share from $1.60 to 90 cents. So no one's immune from what's going on in this industry. But I think what super investors like Tom Gayner and Seth Klarman are looking at, they're thinking about the long-term margins of this business. And they're looking at it now hitting around 8%. Maybe it drops lower. Maybe it goes to 5. Maybe it goes to 7. But they're thinking long-term, over a multi-decade perspective, will this type of business still be able to generate, let's say, 8, 9, or 10% margins? And if you can, you might be able to generate an attractive return. I think that's what they're thinking about. I think they consider that the business model hasn't been disrupted. So as I look at the current share price for Dollar General, looking at a business that has certainly gotten beat up, looking at lowered guidance where investors have less confidence in management, interest expenses are going higher as interest rates are moving up, that certainly hurts the stock. But if you think, like I believe Seth Klarman and Tom Gayner suspect, that they can maintain 8 to 9% margins over time, and let's say get inflation GDP plus type growth over time. So not even talking about market share gains, and you have a market-like multiple or even a discount combined with the free cash flow they generate, that this is, that you could potentially pencil out a teens or 20% return over time. I think that this is what these super investors are looking at. Now, keep in mind, this is a hypothetical framework. Of course, the stock price can go way higher, way lower. I broadly look at this and I consider a couple of different things. One, is this deep value? I don't consider it deep value. I consider this, despite having deep value investors like Seth Klarman, who literally wrote the book, Margin of Safety, despite them starting to get involved with Dollar General, I don't yet put this in the deep value camp where you can say, hey, this has hundreds of percent upside. I think what you're looking at is maybe, 100, 200% type upside, which is certainly in the camp of, I suspect this could outperform the S&P 500 over time. I'm still, of that mindset. I previously did a video before it fell on their recent earnings where I said that. I still have that mindset that Dollar General, I don't think it's been fundamentally impaired. I think they're facing near-term challenges, but 5 years out, could you see more normal margins of 8, 9%? I think in that case, if you get there, then you're looking at a return that could possibly beat the S&P 500. So I do like it. And I also think, I think it's unlikely that the dividend gets absolutely cut. So you're going to get paid at, at around 2% to wait, if you want to hold it during that time. I personally, I'm always thinking about cash, and I keep my cash at Interactive Brokers where I'm getting a little under 5%. See the link below. But it's important to recognize on this channel, I'm going to call out things, thumbs down, oftentimes thumbs up on some things where I think it can outperform the market. But that doesn't mean I actually buy it for my own investment journey. I tend to be much pickier, or even pickier for my own personal portfolio that I call out to my subscribers at Unraveled Investing. And there's a few reasons why. So a few key things on why I haven't made it part of my journey, even though I do think it could outperform. So the first reason is that I prefer owning businesses with a clean balance sheet. I prefer companies with net cash or the opportunity to deploy lots of cash. Whereas Dollar General, they're now in a position of reducing their debt and paying down their debt because they want to make sure, hey, if there's any further business challenges, that debt covenants don't become an issue. So that is something to be mindful of. I also prefer founder-led businesses because generally I think they think better than a hired gun. They're more willing to take the pain that, let's say, short-term, hired gun management might not, be willing to do. And there's also been several studies that show founder-led businesses tend to do better over time. So most of my top holdings all have a significant founder, or the founder still owns a lot of the stock, can pull the strings and make sure things are being run well. So I look at this and I'm not seeing that. So it's another sort of check against why I wouldn't buy. Another key aspect is this whole comment about taking share. I'd like it to be much clearer that you're taking share. I'd rather see a business where it's like, oh, the underlying industry is growing 3 to 5%, you're growing 10%. And so, my holdings, I want to own businesses that's very obvious you're taking share, and also ideally faster growth. So those are some of the key aspects. But overall, I do like Dollar General. I could understand why these, multi-billion-dollar institutions that have a long history of outperforming the market have recently been buying Dollar General. It wouldn't surprise me to see them continue to buy, when they report their third quarter, holdings updates. We will see. I'd love to hear your comments below. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. And if you want to learn more about Unrivaled Investing, check out the website. Thanks so much for tuning in.